Good evening, and welcome to the Perspecticast, the companion podcast to the Panda Perspective Substack. This week, we feel like it's important to take stock of some of the moves in the markets, given that it is, of course, quarter end. So it's important to explore what worked, what didn't work, and what we can expect to work in the future, and where we need to concede defeat, if anywhere. Spoiler alert, no defeats conceded this time around. We are quite happy with where we are, performance-wise. We're not going to be talking about the Panda portfolio performance in this podcast, given that this is a free product, and the portfolio product is obviously is behind the paywall, but suffice it to say that we feel quite comfortable with where we are, and with the overall level of performance for the quarter. And if you're interested, do please check it out. It's not out of line with the major indices, ETFs, and various other products that are out there, but I would say with a little bit less volatility, maybe with a little bit more of an idea behind it, which is kind of what we were going for to begin with. Let's begin with accepting the facts, right? What worked this year, or so far this year, what worked this quarter, was first and foremost the Hong Kong and US listed equities outperformed those ones that traded in China onshore. This has been the thesis that we have put forward at the end of last year. So it was gratifying to see it come to fruition in the first quarter of this year. We believe that the reasons for that were clear, the valuation gap, right? And that valuation gap has now, if not closed, certainly narrowed to the point where the mainland equities look reasonably attractive again. But not only have the Hong Kong and American listed Chinese equities outperformed the mainland names, of course, they've also outperformed the US names, the Japanese names, the Indian names. So looking at the quarterly performance of the Nikkei, for example, down almost 11%. Compared to that, you look at the MSCI China performance of 16% up, right? I mean, that's a 26% gap. It's a big move for a quarter, right? Similarly, now, obviously, this comes on the back of a fairly strong 2024, but disastrous 23 and 22. There's always a question of a starting point, but let's focus on quarterly moves at this point in time. What else worked, right? I mean, we can talk about commodity equities that have done all right. In fact, quite strong, done quite well in the US space, especially lately. But if you look at like oil, right, it's barely moved on WTI, right? Lots of volatility either way, but quite frankly, wherever we are where we started, right? Copper in the US is up a lot, but then copper in London is only up 10%. One thing that I will maybe be doing more of is using Chinese listings for commodities on account of a very vibrant industrial market in China, right? There are very fewer speculators and a lot more of actual users in those markets, relatively speaking now. When I say fewer speculators, doesn't mean there aren't any. Of course, there are. Financialized commodities are, of course, a big thing in China as they are elsewhere in the world, but absolutely, the industrial usage and industrial customers of Chinese brokers play a bigger role over there than they do especially on the COMEX and places like that. Now, having said that, of course, we understand that these markets are global and you can't have prices differentiate for too long because, as we've discovered with oil after the Russian invasion of Ukraine, that fungibility in commodities is a real thing, and anyone who's betting against it is bound to lose. So, oil basically flat, S&P down 4.5%. Big outperformance by the MSCI China, right? With that said, if you look at Chinese onshore, equities, they're basically flat. 30 bips, 40 bips, depending on which one you look at. Chinext is a little bit stronger than the others. But really, the onshore equities have lagged so far this year, and it is the K-Web that has done most of the heavy lifting. Overall, again, similar to what we would have anticipated in January this year. On the most recent episode of the Market Huddle, Kevin was sharing his experiences of going to America early in January and everyone being so bullish US assets. I too have been to America at one of the same conferences that Kevin's been to. And yeah, absolutely. I've heard those very bullish views on America and how Trump and his presidency is going to be a godsend for them. And it might still end up being a great thing for America in the long run. It's just for American equities, at least in the very near term. term, it's been trickier than maybe people have anticipated, and it might get trickier still. But obviously, that is not the realm of our endeavor. We're focusing on the Zhongguo, China. And quite frankly, moving on to expectations for Q2 now, we're getting more bullish, if anything. Everything that we wanted has basically been codified in the NPC meeting. The current readings of the economy are pretty strong. I've done a presentation on consumption for some of our private clients, and the data speaks for itself. It's quite strong. Already, this is before any of the stimulus measures have really started to sort of filter through. We've talked about it with Rupert, Blind Squirrel, last week, that the income has never been the limiting factor on the Chinese consumption story. It's always been confidence. Right? Confidence and some structural issues to do with costs of life, really, for some segments of the population, specifically ones who are not covered by the hukou, the right to live and therefore receive government services in the city that you happen to be working. So given that these constraints are not entirely psychological in nature, but certainly it's a good way of approximating what it is, right? This question of confidence, question of desire to improve your consumption level today at the cost of maybe risking certainty of tomorrow in the environment where you're not, well, I mean, if the degree of certainty in tomorrow is low, right? I mean, obviously you wouldn't want to do that, right? And this is your Econ 301, the intertemporal choices, right? But really, it's quite a straightforward case. Provide people with certainty and more certainty, and they will be much more happy to spend money today, which is sort of what's happening. We have been getting progressively more happy to commit more capital to A shares as opposed to stick to the international names. Now, this is by no means a definitive shift. This is a opportunistic move because we believe there is absolutely going to be a catch-up move of domestic Chinese A shares. This is because all these policies are benefiting the stock markets. It's just it takes a while for them to filter through. In terms of better deal, better yields, obviously this was Hong Kong, right? The cheaper, like if you look at things like broker shares and asset managers and things like that, the discounts were 30% at the start of the year. They've started to come down quite a bit, right? Now, not at zero yet, but then historically the premiums have been around 10-15% on average, right? Actually, there have been times when the premiums were negative, i.e. The Hong Kong names were at a premium. This is all, you can internalize this quite easily, right? Hong Kong is a much more international investor base, and access of domestic investors to Hong Kong has been limited. Now, this is changing, of course, with southbound and northbound stock connects, the system that allows onshore investors to buy offshore stocks and vice versa. In fact, it's important to note that this quarter has been a record-breaking quarter for the Stock Connect, right? The mainlanders put their money to work in Hong Kong, either to unseen numbers, and quite frankly, we're very happy for it. And again, it's important to note that the deal did seem better in Hong Kong at the start of the year. Now, after a big move in Hong Kong, that's no longer the case, and we can fully expect the mainland shares to start picking up interest as well, and we will be very happy for it. We're also happy to see the rally broaden into consumption-related sectors. It's not been the easiest of holes, and some of the better picks of ours have done really well in the consumer discretionaries space, in the internet retail space, in the high-tech industrial space, but all the while your consumer staples have really lagged. They have perked up of late, and we anticipate this trend to continue, and we are very interested in seeing how soon this consumption move will start. Now, this is to remind everybody that, of course, in 2024 started with a very strong move in the consumer staples on anticipation of consumption coming back in 2024 as a result of the COVID restrictions being lifted, in 23 as a result of the COVID restrictions being lifted, and in 24 as a result of consumption normalization and the economy picking up. Now, both of those times, we had a rug pulled from underneath us quite severely, and if you look at the charts for, let's use beer companies as an example, you'll see a very strong rally in the first quarter and the early part of the second quarter in 23 and 24, only to sell off quite dramatically over the course of May and the summer. Now, we believe that the rally starts later and doesn't sell off quite as much this year. And in fact, from current levels, probably doesn't sell off at all. I mean, Not to say that on a daily basis, of course, things go up and down, but conceptually, from here, we fully expect the consumer place to do a lot better. And we have quite a wide network casting in that regard. However, the real jewel of all of this is, of course, to do with the more interesting Chinese companies, Chinese leaders in technology, worldwide leaders in technology, of which there are some. And of course, we are going to do a focus on robotics, for example, and be on the lookout for that. That is the next big thing to be addressed by the blog. Now, of course, we promised it earlier and ended up writing a big thing on the battery, but of course, batteries are very important for robotics. And it is following that particular thread, we pulled on it and realized that our battery pitch needs updating, which we did. And please check it out. That is freely available to everybody. The link is going to be in the description. Otherwise, consumption, shares, and Chinese technology leaders. Those are the three themes that we see for the second quarter and beyond, and we are very excited about it. Again, I cannot emphasize this enough. We were trying to make it clear with our enthusiasm over the course of the first quarter, but this is a great time to be an investor in China. It's interesting, it's exciting, lots of things are happening all at once, most of them good, not all, but most. And we're just happy to be a part of it. And quite frankly, we're trying to share the enthusiasm with you. And if you have an interest in following this story along, please do subscribe, join, and we'd be very happy to have you. So have a lovely week ahead and be on the lookout for the first robotics piece later in the week. Bye.